we are making a decision to invest in the 737 family. We are announcing the 737 MAX.
This is a market that's being driven by demand from low-cost carriers, by demand from emerging and developing economies, and by demand to replace older, less fuel-efficient aircraft. In fact, our forecast over the next 20 years is a total demand of more than 23,000 single-aisle airplanes, a market that's valued at close to $2 trillion US.
Our airline customers are going to love the 737 MAX.
Boeing 737 passenger jet crashing off Indonesia.
Boeing jet missing off of Indonesia.
The tower losing contact just 4 minutes after takeoff. The plane in a terrifying plunge. Debris spotted in the water tonight. Rescuers forced to suspend the search for survivors for now.
There were 62 passengers and crew on board the flight SJ182 when it crashed shortly after takeoff. There are believed to be no survivors.
How could this happen? In its origins, Boeing stood for innovation, trust, and the dream of flight itself. But somewhere between Wall Street targets and boardroom ambition, the company lost altitude, and 2 tragic crashes quickly brought it back to Earth. Parents, children, pilots, gone because safety became secondary to stock prices. Boeing, once an icon of engineering pride, traded integrity for profit, spending billions to please shareholders, while neglecting the very people who made their planes fly. This tragedy wasn't an accident. It was the predictable outcome of a system where money mattered more than morality. Today, we examine how governance, not gravity, brought Boeing to its lowest point, and how it now fights to rebuild what greed destroyed. From an agency theory perspective, Boeing's failure from 1997 to 2018 stemmed from a misalignment between shareholders' long-term goals and executives' short-term incentives. After merging with McDonnell Douglas in 1997, Boeing's culture shifted from engineering-led to profit-driven management. Executives prioritized stock prices and bonuses, spending over $40 billion on share buybacks from 2013 to 2018. While investing far less in research and development compared to their main competitor, Airbus. A finance-heavy board with no safety committee failed to challenge leadership decisions. This governance model fueled the rushed, low-cost 737 MAX program, where cost-cutting overtook safety, leading to 2 crashes, 346 deaths, and over $20 billion in losses. Boeing's story demonstrates how misaligned incentives and weak oversight can erode engineering integrity and destroy stakeholder trust. A governance philosophy grounded in stakeholder theory could likely have prevented the 2 fatal 737 MAX crashes by ensuring that Boeing's board prioritized safety, transparency, and long-term engineering investment ahead of short-term shareholder returns. Between 1997 and 2018, 2 key stakeholder groups were systematically neglected. The first one is composed by the employees and engineers whose safety warnings were ignored and morale eroded under relentless production pressures. The second, customers and pilots who were denied full MCAS training to save airlines approximately $1 million per aircraft. This approach reflected a governance model that elevated cost control and delivery targets over product integrity and operational safety. Financial data from the case illustrate how profit-focused governance destroyed long-term value. Between 2013 and 2018, Boeing spent over $40 billion on share buybacks, while directing only 4.5% of commercial sales to research and development, roughly half the R&D intensity of Airbus. By 2024, the company reported a net loss of $11.8 billion, a 33% decline in commercial revenue, over $2.5 billion in Department of Justice settlements, plus $237 million in derivative litigation costs, and a market share drop from 65% to below 40%. These outcomes demonstrate the direct link between governance design and corporate performance. A stakeholder-oriented board mandating engineering integrity, employee voice, and customer safety would have balanced financial discipline with long-term resilience, mitigating both the human tragedy and the severe financial losses that followed. So since Kelly Ortberg took over Boeing in August 2024, there's been a clear shift in how the company is governed, moving away from an agency-based model focused only on shareholder value and short-term profits, toward a stewardship-based approach that emphasizes trust, safety, and long-term stakeholder value. Before 2019, Boeing's leadership prioritized stock prices and cost-cutting, spending over $40 billion on buybacks while slowly eroding its engineering culture and safety oversight. That short-term mindset eventually led to the 737 MAX crisis, which really exposed the dangers of purely financial governance. Now, under Ortberg, Boeing is trying to rebuild from within. The company's 2024 annual report mentions safety over 60 times, compared to just 4 mentions back in 2011, a symbolic but very real shift. The new corporate vision puts safety, quality, and transparency at the core of performance, nurturing their new approach from the firm's roots as a top engineering mecca. Ortberg also moved the headquarters back to Seattle, reuniting leadership with the engineering heart of the company. He's been seen walking factory floors and talking directly with employees, showing a genuine effort to reconnect culture, rebuild morale, and earn back trust. Plus, after resolving a major labor strike, Boeing approved significant wage increases and improved retirement benefits, signaling that employees are once again being treated as key stakeholders, not just costs. In short, Boeing hasn't fully completed this transformation. It still faces big financial pressures. But under Ortberg, it's clearly moving from an extractive, profit-driven model toward a restorative, people-centered governance that focuses on rebuilding legitimacy through trust, transparency, and safety. Under David Ortberg's leadership, Boeing is pursuing a cautious but deliberate recovery. His strategy focuses on stabilizing cash flow before launching new aircraft programs, restructuring the workforce, cutting about 17,000 jobs to regain cost discipline, and deferring major research and development projects until the company's finances improve. Most importantly, he's working to rebuild stakeholder trust, especially among employees and airline customers, as the foundation for long-term growth. Yet, this defensive stance comes with risk. While Boeing plays it safe, Airbus and China's Comac are pushing forward with innovation in narrow-body aircrafts. Without renewed investment in research and development, Boeing could slip from industry leader to follower. For now, any desire for investment should proceed with caution. Boeing shows early signs of renewal under Ortberg, but its financial instability, lawsuits, and weak profitability make a major investment premature. A small strategic stake with close monitoring is justified, but full commitment should wait until Boeing's reforms clearly translate into sustainable profits and restore trust. Boeing's story is more than a business case, it's a warning. When profits silence engineers and numbers outweigh human lives, tragedy follows. The company is now trying to heal, to earn back the trust it once shattered. But rebuilding integrity takes more than new policies or slogans. It takes courage, accountability, and time. The path ahead is long, and the scars of greed run deep. Yet if Boeing can truly put people before profit, perhaps the next chapter won't be about loss, but redemption.